What if an AI saw the market collapse, before the world even knew it was coming? No human saw the pattern, but AI connected 10,000 signals in a single second. Now the real question isn't if AI can trade, it's what happens when AIs start trading against each other. The academic seedbed, 1980s, 90s. While Wall Street ran on gut instinct and basic charts, computer scientists and econometricians published theoretical papers exploring neural networks for time series forecasting. They argued that financial markets were not purely random walks, but contained complex, nonlinear patterns, chaotic signals buried in noise that traditional statistics couldn't capture. This was a fringe idea, more relevant in university labs than trading floors. The quant vanguard adopts ML, late 1990s, early 2000s. Pioneering quantitative hedge funds like Renaissance Technologies, founded by mathematician Jim Simons, began their secretive work. They didn't call it AI publicly, but used advanced statistical learning and pattern recognition on decades of data. Their success, e.g., the Medallion Fund's legendary returns, became the industry's worst-kept secret, proving that data-driven, automated systems could achieve superhuman scale and discipline. The Alternative Data Arms Race, 2010s. The realization dawned, everyone had price and volume data. The edge would come from novel data. Firms hired data archaeologists to find and digitize new signals. Satellite imagery, counting cars in retail parking lots to predict quarterly earnings. Web scraping, tracking product prices and reviews on Amazon. Geolocation data, analyzing foot traffic to stores from smartphones. Sentiment data, aggregating news and social media tone. AI became the essential tool to process this vast, unstructured exhaust of the digital economy. The foundation of speed, high-frequency trading, HFT. HFT firms like Citadel Securities and Jump Trading built the nervous system for the future AI brain. They invested billions in microwave towers, co-located servers, and custom chips to shave microseconds off trade execution. This created an ecosystem where speed was paramount and the battlefield was primed for something smarter than simple arbitrage bots. The proof of concept, a defining win. A concrete victory silenced internal skeptics. For instance, an AI model might have identified a fleeting, multi-market mispricing between a stock, its futures contract, and an ETF, a pattern too complex for human traders to see and act on in milliseconds. The trade executed flawlessly, booking a large profit and irrefutably demonstrating AI's potential for capturing invisible opportunities. The black box gold rush. Success stories spawned a frenzy. Venture capital flooded into AI trading startups. Sales pitches promised self-learning algorithms that would decode the market's DNA. Terminologies like deep learning, neural nets, and recursive networks became buzzwords. The opacity of these models was often marketed as a feature, not a bug. Their genius was supposedly beyond human comprehension. Wall Street and Silicon Valley collided. Hedge funds started poaching star PhDs from Google and Facebook, offering compensation packages worth millions. Quant became the most coveted job in finance, and firms built lavish research labs that resembled tech campuses more than traditional trading floors. The multidimensional pattern hunter. AI models evolved beyond single-asset prediction. A next-generation system might link supply chain sensor data from Taiwan, semiconductor production, shipping freight rates in the Pacific, patent filings from tech companies, output, a predictive score for the global tech sector's health weeks before traditional analysts could see it. The sentiment decoder. NLP AI transformed textual noise into a tradable signal. Systems like Reuters News Analytics or bespoke models could parse a Fed chair's speech in real time, flagging a subtle shift from hawkish to dovish. Detect rising anxiety in Twitter chatter about a bank. Cross-reference executive optimism in earnings calls with hard data to spot discrepancies. Peak hype and performance. At its zenith, funds like 2 Sigma, D.E. Shaw, and Citadel, with their AI-powered strategies, consistently topped performance lists. They appeared to defy gravity during volatile periods, claiming their AI saw through the emotion. The narrative solidified, AI was the future, and human traders were obsolete. Assets under management for systematic funds soared. The black swan failure. The inevitable happened. An event like the COVID-19 market crash of March 2020 or the UK gilt crisis of 2022 occurred. These were structural breaks with no true precedent in training data. AI models trained on correlations from a decade of low interest rates and steady growth failed catastrophically. Some, designed to reduce risk, ironically amplified the sell-off through forced, automated liquidation. The black box was now a burning box. Exposing the core flaw, overfitting and regime change. The failure illuminated a fundamental truth: AI is a master of interpolation, not extrapolation. It excels within the known bounds of its training data but struggles with genuine novelty. Critics argued many models had simply become excellent at curve fitting, memorizing past quirks rather than learning underlying economic cause and effect. Regulatory backlash and the explainability mandate. After incidents like the GameStop short squeeze, where retail sentiment overwhelmed quant models, regulators stepped in. The EU's AI Act and the SEC's increased scrutiny demanded accountability. The question, "Why did your AI make this trade?" needed an answer. The model decided was no longer acceptable for risk management, compliance, or investor trust. The pragmatic pivot to explainable AI, XAI. The industry entered a sober, engineering-focused phase. The goal shifted from building the most complex neural network to building the most robust and interpretable system. Techniques like SHAP values, quantifying each input variable's contribution to a prediction. Causal inference, moving beyond correlation to model cause and effect. Hybrid models, combining deep learning's power with simpler, interpretable, guardrail models. The Oracle was being dismantled and rebuilt with inspection panels. The Great Consolidation. The hype bubble burst. Many pure-play AI funds shut down. The survivors were those who integrated AI as a core, but not sole, component. The technology was demoted from Oracle to superpowered assistant. Large asset managers like BlackRock and Vanguard began using AI for portfolio construction and risk analytics, not speculative betting. The cyborg trader paradigm. The new optimal model emerged, the human-machine partnership. AI's role: process petabytes of data in real time, run 10,000 market scenarios overnight, monitor every position for hidden risks, and surface anomalous patterns. Humans' role: provide the why, the geopolitical context, the understanding of irrational market narratives, the ethical framework, and the final strategic decision. The human steers, the AI navigates and powers the engine. AI as guardian, risk and compliance. Perhaps the most transformative and least glamorous application took root. Banks now use AI to simulate what-if scenarios for climate risk or geopolitical shocks. Detect complex money laundering patterns across billions of transactions. Monitor all employee communications for insider trading risks. This defensive, operational use of AI became a massive, mission-critical industry. The generative AI inflection point, 2023 present. The arrival of LLMs like ChatGPT didn't create new trading signals, but it revolutionized the interface between humans and data. A PM can ask, summarize the bearish arguments for this semiconductor stock from the last 12 analyst reports. An AI can draft an earnings preview, simulate a tough Q&A, or translate a technical Fed paper into a bullet point memo. It democratized deep analysis, making every PM and analyst more efficient. The next leap, reinforcement learning, RL. Instead of just predicting the next price, RL agents are trained like game-playing AIs, AlphaGo for markets. They learn by taking simulated trading actions in a virtual market and receiving rewards or penalties. The goal is to discover complex, multi-step strategies, like long-term option positioning or dynamic hedging, that no human explicitly programmed. The self-modifying ecosystem. The end state is not a single AI beating the market, but the market itself becoming an ecosystem of interacting AIs. Most liquidity and price discovery are provided by algorithms talking to other algorithms. This creates a market that is incredibly efficient and liquid under normal conditions but prone to sudden, incomprehensible flash events when these AIs interact in unforeseen ways. The story concludes with finance now existing in a new, perpetually evolving environment of its own creation, where the ultimate role of humans is to be the system's architects, philosophers, and stewards.